I do think as gold has now made new all-time highs, it's started to come into focus for younger generations that kind of wrote it off and saying, hey, listen, this is a more stable asset that can still go up in value, but ultimately it's not as volatile as a cryptocurrency like Bitcoin that can go up or down 20, 30% in a day or a week. And so I think it is starting to catch on. But I think one of the bull drivers is that the average investor is still unbelievably underweight gold in their portfolios. And that, again, if that weight just comes back to the average historically that gold was in people's portfolios, you do see a significant further upside on gold because of that. So I think it's at the very early stages, which definitely tells me that, for me, my 1 to 2 year outlook is north of 3,000 very easily. And then obviously that 6,000 and change target would be kind of a 5-year plus target price out there.
Western investing sentiment towards gold bullion rose in August as prices hit fresh all-time highs, writes Adrian Ash at world-leading marketplace BullionVault, now caring for $4.8 billion of precious metal for over 100,000 users from 175 countries. Autumn 2024 offers plenty of reasons to start investing or building a position in gold. From today's rising recession risks to overstretched stock markets and worsening geopolitical conflicts, Master Trader Gareth Soloway is confident that gold will reach $2,660, driven by a long-term trend line from the 1979 and 2011 highs. He believes this target could be met by year-end, supported by the Federal Reserve's likely return to easy money policies, central banks' gold buying, and global debt reliance. The rally for gold is still going strong, with most analysts expecting further gains. However, after 30 record-high settlements so far this year, investors should look for signs of a potential top in prices for the precious metal. Based on historical gold bull runs, like the 750% increase from 1976 to 1979 and the 630% gain from 2001 to 2003-2011, Soloway suggests a pattern of decreasing percentage gains. Despite this, he predicts a potential 500% rally from the 2015 lows, potentially pushing gold prices to around $6,300. He playfully refers to it as a wish list target, suggesting that a rally of this magnitude would be highly desirable for gold holders. According to Goldman Sachs, investors should go for gold of all the commodities available as it looks poised to continue its record rally into 2025. The bank said in a Sunday note that gold should hit $2,700 per ounce in early 2025, representing a potential upside of about 7% from current levels. Now we present the clips of Gareth Soloway's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
That's quite the move on gold, to be fair. Like, it's really been a strong move up. I do think that we're a little bit overbought in the near term, but I still think gold has more upside to go. So let's just jump into the chart and take a look. And what we can see here is that gold right now is right into that $2,500 level. And so what that means to me, and there's a couple things here. So there's different time frames that a trader can trade or an investor can look at. You can either have the shorter term or the longer term. Now, the longer term, there's still further upside on gold. My next target is $2,660. I'll show you in just a minute how I arrive at that target price. But I just want to show you guys this. This is something that is a little bit concerning to me. This is called the RSI, and this is a shorter term signal telling us that gold may pull back in the near term. And what we have here is the RSI tells us relative strength. It's the relative strength index. And the only thing you care about on this is the divergences. Now, in terms of price, look at price. Price has gone up and made it the high and a higher high. But if we look at the RSI is downsloping if you connect the highs, and that is a lower high on the RSI. That's called a negative divergence. So what that tells me is we likely will pull back in the near term, but then use that as a buying opportunity. And just to give you guys a sense of what I'm kind of looking for, I would look for this trend line right here, a pullback to about 2,400, and then at that point start buying again for that next bigger move up. And I think ultimately, I think we all agree, everyone watching this probably agrees that the Fed is going to go back to easy money policy. They'll probably expand their balance sheet. Central banks continue to buy, which is a bullish indicator for gold. And the U.S. government and really governments around the world continue to use debt as their main way of financing, which for precious metals is a long-term recipe for success. Now, lastly, I'll just throw this up. I'll show you guys how I get my target. I flipped over to the logarithmic charts, which allow me to go back to a long time ago and use trend lines. I go back to my 1979 high right here, we're going to connect it to our 2011 high. And when we do that, a trend line comes into focus here, where if we look at that trend line, it's right around that 2660 level. So I think, again, whether or not it's by the end of this year hitting that, or if we can hit it just, in the new year, I'm not sure. But I do think this is pretty much the next leg up for gold that'll take us about $130, $140 higher from here. For me, things like this, right? If we flip back to our regular chart from our logarithmic chart, we can look and say, and this is kind of an interesting one, right? So this is something I was playing around with. So if we look at the bull run that took place on gold from 1976 to 1979, that 1979 high, it was about a 750% bull run. If we look at the low in 01 to the high in 2011, it was about 630%. So it seems like it's slowly moving lower by about 120%, in terms of the upside. But that still puts us at about a 500% rally off of the lows from 2015. Now, this is kind of if we had our, for those of you out there like me that have holdings in longer term in gold, this is like the magic, like everyone wants to hear this. And if we do that and we go up 500%, I have to keep dragging my chart down here to kind of get that into play, but we still have to keep going here. So we're almost there at this point, guys. But really what we're looking at is, let's say we do 500%, you're looking at around a 6,000 price target. And again, just to understand, that would be 750 was the first bull run, 120% less is the next one, and that's easily measured. So if we do 130% or 120% less on this next bull run, it takes us to about 6,400, 6,300 on gold. So that would be kind of the wish list. I think we all would love to see that. My only caveat to that would be this, is that if gold goes there, I do worry about what the macro economy and the global economy looks like. I mean, that is, all of us that are gold bugs, we buy gold for protection, but also we have to recognize that if the instability hits where gold goes up that much, how much other risks are there to us in society, essentially. So I would just throw that out there to keep that in mind.
Silver's recent dip highlights concerns about its short-term performance amid economic instability. According to Gareth Soloway, if silver falls to approximately $24, it could present a prime buying opportunity with promising long-term potential despite current challenges. Silver has gained mostly due to buying in India and China, as well as the so-called paper silver. Investors in July showed a renewed interest in silver ETFs, which had $300 million in inflows following 2 months of outflows totaling $1 billion, according to BlackRock's latest global ETP flows report via ETF.com. Last week, the metal followed gold higher, breaking through $30. So far this year, it is up 28% compared to gold's 23%. Regarding current market trends, Soloway predicts rising gold prices will boost gold miners' performance, especially if gold surpasses $3,000 per ounce. He notes that recent breakouts in GDX indicate strong potential, though he advises staying diversified and prepared for near-term pullbacks. Let's get back to the interview.
Silver right now, we are seeing a down day. It's had a nice move up. Same kind of deal. If you look at the low on silver here, this was right when the stock market bottomed out as well. The stock market's getting a little iffy now as we're going into these NVIDIA earnings and then the PCI data later this week. So we are seeing silver pulling back. So I'm definitely not quite as bullish in the short term on silver because there's that industrial side where silver is affected by the economy, how good the economy is. If we look at other charts out there, I mean, I think you have to pay attention to something like a nickel. I mean, nickel has just plummeted. It's come off its lows, but I mean, this is a massive decline in nickel, and you can look and see some of these other declines in these commodities as well. And so the industrial side seems to be really suffering, almost telling us that there is going to be a recession. In fact, that's one of my base cases, is that if you look at a lot of these industrial metals, they've been crushed, and that is telling us something. Like even copper. I mean, taking a look at copper. Now, copper doesn't have the rarity, neither does nickel, of silver, but still there's a huge portion of investors, or at least in the industrial side, that's what silver is used for. So again, same thing with copper. Copper, we've had a rally because the stock market's rallied. That narrative of a soft or no landing has come back in. But with silver, that's my biggest concern. It's that if the economy does weaken, silver's going to have a lot more trouble rallying versus the safety and kind of the safe haven asset that gold is. So for me, if silver were to come back into this level, take a look at this level. This is a great level here. There's a long-term trend line here. And then we also have this parallel channel. So these two lines will meet somewhere around $24. I know people don't want to hear it potentially goes to 24, but look at it like a great buying opportunity. Since I do think longer term silver does go a lot higher, I would look to buy at these key levels pretty aggressive. I do think that as gold goes up more and more, it starts to influence the gold miners more and more, meaning that they should outperform more and more. And I think the key is this, is that everyone has a profit margin. And with inflation over the last 5 years, that's why GDX and gold miners underperformed, because gold wasn't going up, yet inflation was skyrocketing. And so they were paying their miners, their equipment costs were going up. All of these costs were going up. Now, gold is starting to move up, which is compensating them for that additional cost. But the more gold goes up, when you can get $3,000 an ounce for what you could only get $2,500 prior, that almost is pure profit for the miners. And so ultimately, if gold really does go on a bigger bull run north of 3,000 and inflation stays, let's say, at 3% or so, it really does put a good spin on the positivity on GDX. And I just want to show this chart. This is a classic wedge pattern. And you can see wedge patterns, by the way, just to define it for the audience, is you have a low and a big move up to a high. And then from that point, it's tinier and tinier, lower, each low is a little higher, each high is a little lower, and it creates this kind of essentially a triangle pattern. Now, this is kind of what we call, it's a winding spring. So it's tightening, tightening, tightening. And then once it breaks out, it really goes pretty parabolic. And we can see that once that broke out, it really had this beautiful up move where we've gained about 35% on GDX in the near term. Now, if gold does pull back in the near term, I think GDX gets pulled back as well. But that can be a positive for us as investors because we can find these levels to actually have entry opportunities on GDX. So for instance, if GDX notice pivot low, pivot low, pivot low, this tells me that if price hits here, this would be a place to start a position long on GDX at around $34.50, we'll call it. If it continues down, you always have a chance that it would retrace into these two lines down here, which could be an additional accumulation zone. But I think the key is, as long as we hold that longer term perspective on gold, that the economy, that the debt levels, that the Federal Reserve banks will continue to kind of print money for every situation of hardship, then you do want to just continue to move into gold miners. But as I always say, folks, stay diversified. So a little gold, a little silver, a little miners, because again, you just never know which is going to be the big winner. Like you said, gold has actually performed equally as well as the miners up to this date.
While Goldman is bullish on gold heading into the end of 2024 and the beginning of 2025, and the Kobayashi letter sees demand from central banks continuing to push it higher, the yellow metal must first get through September, which has been a bear of a month going back to 2016. What are your thoughts on the potential impact of rising gold prices on the broader market? How do you plan to adjust your investment strategy in light of current trends? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.